Something happened in Canada that most people probably missed at first, but the people who watch global economics for a living caught it immediately. And honestly, the moment was almost quiet. Just a single word. One word spoken by Prime Minister Mark Carney during a live address to the Canadian Parliament. Cameras were rolling, financial centers around the world were watching, and he described Canada's entire economic shift with a term that sounded simple on the surface. He called it a pirouette. Now, that word landed very differently depending on who was listening. Inside the chamber, people understood the reference almost instantly. In the markets, the meaning sank in within minutes. And in Washington, well, the reaction there came quickly too, just not in the form of policy. 14 posts in 3 hours. A lot of anger. A lot of threats. But nothing that actually changed the situation. Because what Carney signaled with that word wasn't a slogan. It was a declaration. A signal that Canada intends to rotate away from its economic dependence on the United States, using pressure from Washington itself as the momentum that completes the turn. And to really understand why that word carries so much weight, you have to go back a little. Decades back. Canada's 15th Prime Minister, Pierre Elliott Trudeau, once described Canada's relationship with the United States in a way people still quote today. He said living next to America was like sleeping beside an elephant. Friendly or not, every movement of the elephant affects you. So Canada developed strategies for managing that reality. Trudeau called one of them the third option. The idea was simple in theory, but complicated in practice. Diversify trade relationships so Canada would have more room to maneuver internationally. Less dependence on a single partner. More flexibility. Back in the early 1970s, when Canada shifted some of its diplomatic focus toward Europe, observers described the move using that same image, a pirouette, a controlled rotation on one point, balanced, deliberate, changing direction without losing momentum. So when Carney chose that exact word, it wasn't random. It was deliberate, a reference to Canadian political history, a signal to Canadian voters that this strategy has precedent. And maybe more importantly, a message to the rest of the world that what Canada is doing now isn't a panic reaction. It's planned. And here's where things start to become very concrete. Because the pirouette Carney announced isn't just rhetorical language. It's a coordinated economic shift across multiple sectors at the same time. Something that appears to have been prepared for more than a year and a half. The first part of that shift involves trade flows. Right now, roughly $550 billion in Canadian goods and services go to the United States every year. That's about 75% of Canada's exports. One of the most concentrated trade relationships anywhere in the world between two large economies. For decades, people treated that concentration almost like geography. Something fixed. Something that existed simply because the countries sit next to each other and their industries are deeply connected. But Carney framed it differently. He treated that dependency as a policy choice. A choice that made sense under one set of conditions and maybe doesn't make sense anymore. So he announced a target that caught the entire room off guard. Canada intends to reduce that American export share from 75% down to 50% within 5 years. 25 percentage points in 5 years. That isn't gradual diversification. That's a rapid restructuring of trade patterns. And the destinations for that redirected trade are already part of the plan. Partnerships with countries connected to the Davos Manifesto signatories, cooperation with the BRICS Plus Energy Framework, and bilateral agreements that Canada has been assembling quietly with places like China, India, and several Gulf states. That's the first movement in this pirouette. The second one is financial architecture. And this part moved just as quickly. Carney announced that Canadian government procurement contracts with foreign suppliers will now be denominated either in Canadian dollars or in the supplier's own currency. No exceptions going forward. Which means those transactions won't rely on US dollar clearing systems anymore. At the same time, the Bank of Canada expanded bilateral currency swap lines covering the countries involved in that broader framework. The total liquidity available through those lines sits at $680 billion. That number alone signals something important. because it means this shift away from dollar settlement isn't theoretical. It's already funded and operational. And then there's the third dimension of the pivot: energy. Canada currently sends about 85% of its energy exports to the United States. Under the new policy directive Carney announced, the goal is to reduce that share to 60% over the next 7 years. A new agency, the Canadian Energy Diversification Authority, will negotiate supply agreements with buyers in Asia and Europe while coordinating pricing discussions with energy partners in the broader BRICS Plus framework. And the reason this matters so much politically is because American Midwest refineries were designed over decades to process Canadian heavy crude. Switching away from that supply would require serious investment, which means if Canada shifts even part of that oil toward other markets, the leverage changes direction. Now, once that announcement landed, the response from Washington was almost immediate, and in some ways, completely predictable. The posts started appearing online within minutes, one after another, 14 of them over about 3 hours. Prime Minister Carney was called a globalist traitor. Canada's move was described as economic warfare. There were threats of historic tariffs, warnings about emergency powers, declarations that the United States would respond with devastating force. And then the post stopped, not because the anger disappeared, but because somewhere inside the White House, advisors had to look at the actual situation, the real options on the table. And the reality is uncomfortable. The leverage Washington once had is no longer as simple as it used to be. Take energy. It's probably the clearest example. If Canada diverts even a portion of its oil sands output toward Asian markets using the Trans Mountain export route, the effect shows up almost immediately in the American Midwest. Refineries there rely heavily on that specific kind of crude. Replace it quickly? That's not easy. And when supply tightens, gasoline prices move. Now think about where those price increases are felt most strongly. Not on the coasts. Not in large metropolitan centers. They're felt in places like Michigan, Ohio, Wisconsin, and Minnesota, the states that often determine the outcome of presidential elections. So threatening Canada over energy carries a political risk, because it can translate directly into higher fuel prices for voters in the exact places where elections are decided. And energy isn't the only constraint. Agriculture creates another one. Canada imports around $40 billion in American agricultural products every year. If Canada's new strategy redirects some of that purchasing toward other suppliers, countries tied into the same international networks Carney has been building, then American farmers lose access to a market that isn't easy to replace. Australian grain, Brazilian pork, New Zealand dairy. Those alternatives exist. And agricultural organizations in the United States understand that reality very clearly. The Farm Bureau understands it. Senators from farming states understand it. Because if Canada stops buying as much American food, the political consequences land directly in rural communities. So when those threats started appearing online, the strategic picture behind them was complicated. Escalation sounds powerful, but the actual costs might land on American voters just as quickly as they land in Canada. And then something else happened that caught the attention of financial analysts almost immediately. Warren Buffett released a statement. It came through Berkshire Hathaway's investor relations channel only hours after Carney's speech. The timing alone told observers that this was deliberate. Buffett rarely comments publicly on political developments unless he believes the economic implications are substantial. He said that in more than 60 years of watching markets, one of the most reliable indicators of long-term value creation was something he called decisive clarity. The ability of a leader to recognize a situation accurately, choose a direction, and move forward even when the decision brings short-term discomfort or outside pressure. And he said Carney had demonstrated that kind of clarity. Buffett also confirmed that Berkshire Hathaway's exposure to Canadian investments had grown significantly, to the point where Canada now represented the company's largest geographic concentration of international investment outside the United States. Then he added a line that analysts repeated for days afterward. He said the pirouette Canada executed was not a retreat from the American relationship. It was a renegotiation of that relationship from a position of strength rather than dependence. And he added something else that stayed with people. In 60 years of business, he said, he had never seen a negotiation where the party with alternatives lost to the party that had none. When you step back and look at the sequence of events that led here, the pattern becomes clearer. Every tariff Washington imposed created political space for Canada to move further along the diversification path it had already been planning. Every threat accelerated the shift it was meant to prevent. In a strange way, the pressure coming from Washington helped generate the momentum needed for the turn, almost like the push that completes a pirouette. And financial markets responded almost instantly. The Canadian dollar jumped 3.1% in a single session, the largest gain since this economic standoff began. The Toronto Stock Exchange climbed to a new all-time high. Canadian energy companies, materials producers, agricultural processors, and financial institutions all moved upward together. At the same time, the US dollar index dropped 2.1%. American agricultural futures slipped. US automotive suppliers with heavy Canadian exposure declined. Energy companies that had assumed Canadian crude would remain a captive supply source also lost value. The markets weren't making a political statement. They were making an economic judgment. And the judgment was simple. Canada's strategy increased its flexibility. America's position looked less predictable. Price accordingly. So when you step back and look at the larger picture, the pirouette isn't just a Canadian story anymore. It's a demonstration, something that other governments are watching very carefully. Because what Canada showed, at least in the eyes of a lot of economists, is that a major democratic economy can shift its relationship with the United States faster than most people assumed possible. 18 months ago, the level of Canadian dependence on American markets looked almost structural. Something built into geography and supply chains, something that would take decades to unwind. But what this moment suggests is that those arrangements may not be permanent after all. They're historical, and historical arrangements can change when the conditions around them change. That's the signal a lot of finance ministries are hearing right now. Central banks are studying it too. Every country that manages large dollar reserves is paying attention. Because if Canada can gradually reduce the role the United States plays in its trade flows and financial settlement systems, then the assumption that American economic leverage is fixed begins to look a little less certain. And once that assumption changes, the calculations change too. Every government watching this is quietly asking the same question. If a country like Canada can move this far in 18 months, what might another country do with 3 years? That's why the single word Carney used carried so much meaning. It wasn't just language. It summarized an entire strategy in one motion. A shift away from 75% export dependence on the United States towards something closer to 50% over the next 5 years. At the same time, the financial infrastructure supporting that shift is already being built. $680 billion in currency swap capacity to support transactions that don't rely on the US dollar. Procurement contracts designed to settle in Canadian dollars or the partner nation's currency instead of moving through American clearing systems. And on the energy side, a diversification strategy aimed at reducing the American share of Canadian exports from roughly 85% to 60% over the next 7 years. With a dedicated authority tasked specifically with building new supply relationships in Europe and Asia. Put all of that together, and the leverage dynamic begins to look very different. Meanwhile, the reaction from Washington never really evolved beyond those initial posts. 14 messages online, strong language, warnings about tariffs, but no immediate policy move that avoids significant political cost at home. Buffett's comment kept circulating through financial circles during all of this. Decisive clarity. That was the phrase people kept repeating. And his confirmation that Berkshire Hathaway's largest international concentration outside the United States is now in Canada sent its own signal to investors around the world. Then the markets delivered their final verdict for the day. The Canadian dollar rising 3.1%. The Toronto Stock Exchange hitting a record high. The US dollar index sliding 2.1% in the same trading session. Those numbers weren't symbolic. They were prices adjusting to a new reality. And that reality, at least for the moment, looks like this. Canada completed its turn. The alternatives it spent months building are now in place. The economic choreography finished exactly the way the word implied it would: a controlled rotation, balanced, and facing a different direction than where it started. If this helped you see the bigger picture behind what might be one of the most significant economic pivots in modern Canadian history, go ahead and hit the like button, drop a comment about what you think Washington does next, and subscribe so you don't miss the next chapter of the story, because it doesn't look like this one is finished yet.